Hey everyone, welcome back to Corporate Decoder. Today we're diving into a report from the Federal Home Loan Bank of Boston. It's about debt, which might sound boring, but trust me, understanding who owes what and to whom is like knowing the secret code to the financial world. We will uncover its implications and how it might affect you. Before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below where you can discuss these topics and more. This report filed on April 30, 2025 is called a Form 8K, which companies use to announce major events. In this case, it's about the Federal Home Loan Bank of Boston's financial obligations, basically. It's all about their debts. The main point of this filing is to detail the creation of direct financial obligations. In plain terms, it's about the bank taking on more debt. The Federal Home Loan Bank of Boston, like other federal home loan banks, gets most of its money by selling debt securities, which are like IOUs, called consolidated obligations. These are bonds and discount notes. Think of it as the bank borrowing money from investors by promising to pay them back later with interest. Here's where it gets interesting. All 11 federal home loan banks are jointly responsible for these consolidated obligations. This means that if one bank can't pay, the others have to step in. It's like having 11 friends who all co-signed your loan. If you don't pay, they are all on the hook for it. The Federal Housing Finance Agency can make any of these banks repay the debt of another. This makes the whole system very interconnected. Now let's look at Schedule A, the meat of the report. This schedule lists all the bonds and discount notes that the Federal Home Loan Banks are committed to issuing, where the Federal Home Loan Bank of Boston is primarily responsible. But as we just discussed, they are jointly and severally reliable for those debts. This is a list of debts that the bank plans to take on. It doesn't include very short-term debts, those maturing in a year or less that are issued regularly. We can see that some of the debts will mature far into the future. Looking at the table, we can see some dates and numbers that tell the story. The table is divided into rows, each representing a debt that the bank is responsible for. Let's start with the trade date, the date that the trade occurred. On April 30, 2025, the bank committed to issuing a bond with a CQS of number 3130-8FU0, which is like a serial number for the bond. The settlement date, May 2, 2025, is when the bond was officially issued. The maturity date, September 10, 2027, is when the bank has to pay back the principal or the main amount of the debt. Non-QIO means the bank can't pay it off early. Fixed constant means the interest rate stays the same over the life of the bond. The coupon rate is 4.125%, which is the interest rate the bank pays to the bondholders. The bank par is $8 million, which is the face value of the bond. On the same day, April 30, 2025, the bank issued another debt with CQS of 45FF. The interest the bank pays goes up and vice versa, which is the secured overnight financing rate. So if SOFR goes up, the interest the bank pays goes up and vice versa. The amount for this debt is much higher, $250 million. This means that the bank believes that it can take on a large debt without being at high risk. On May 20, 2025, the bank issued another debt with CHU's IP5. The debt is for $50,030,B6A55. The debt is for $50 million if the bank wishes. Also, the debt is of style Bermudan, redeemable on specified recurring dates. It's important to note that the bank can change how it reports this information in the future. This makes it a bit tricky to compare these reports over time, because the methodology will change. Also, the amounts listed here are just the face value of the bonds. They don't include any discounts, premiums, or other adjustments, which could make the actual cost of the debt different. So what does all this mean? It means the Federal Home Loan Bank of Boston is actively borrowing money through various types of debt. Some of this debt has fixed interest rates, while some has variable rates that can change with the market. The bank is also part of a larger system where all the Federal Home Loan Banks are responsible for each other's debts. This creates a safety net, but also risk of contagion if one bank runs into trouble. Now, looking at these numbers more broadly, the Federal Home Loan Bank of Boston appears to be managing its debt obligations in a fairly standard way. The variety of debt types, from fixed rate to variable rate, suggests a strategy to balance risk and cost. The joint liability with other federal home loan banks is both a strength and a weakness. It provides a safety net, but also exposes the bank to the financial health of the other banks in the system. One risk is that rising interest rates could increase the cost of the variable rate debt, which could squeeze the bank's profits. Another risk is that if one of the other Federal Home Loan banks gets into financial trouble, the Federal Home Loan Bank of Boston could be on the hook to help repay their debts. Overall, the Federal Home Loan Bank of Boston seems to be operating in a stable environment. The bank's ability to issue debt at reasonable interest rates suggests that investors have confidence in its financial health. However, it's important to keep an eye on interest rates and the financial health of the other Federal Home Loan banks to assess the long-term risks. Alright, that's our breakdown of Federal Home Loan Bank of Boston's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.